Have you ever heard the saying, slow and steady wins the race? Well, when it comes to growing your wealth, there's no better example of this than the magic of compound interest. Imagine planting a tiny seed today and watching it grow into a towering tree over time. That's exactly how compound interest works. It starts small, but as it rolls on, it gathers size and speed, turning your modest savings into a substantial sum. Warren Buffett, one of the richest men in the world, didn't make his billions overnight. He started investing at a young age and let the power of compound interest do its heavy lifting. Over decades, his wealth literally exploded thanks to the relentless force of compounding. Now, if you're wondering how you can start your journey towards achieving your dreams through smart investing, you're in the right place. In this video, we're going to walk you through some effective compounding strategies for every investor. Whether you're starting with a small amount or you've got a hefty sum to invest, we've got tips and tricks that can help you on your way. So, subscribe to the channel and let's get started. All right, now, before we talk about these strategies, first let's take a moment to really understand the magic of compounding. Suppose you've put away $5,000 into an investment that earns you a 10% interest each year. To understand this, let's take a look at this diagram. In the first year, that investment works out nicely, and you earn $500 as interest. Then, when the second year rolls around, you earn another $500 on your original $5,000. But here's where it gets interesting, because you also earn 10% on the $500 interest you got last year, which adds another $50 to your pocket. That means, by the end of the second year, you've earned a total of $550 in interest. Moving into the third year, things start to heat up even more. You earn your usual $500 on the original amount, but now you also get 10% on all the interest you've accumulated so far. That's the $500 from the first year plus the $550 from the second year. That adds up to $1,005, and 10% of that is $105. So for the third year, you pull in $605 in interest. This process keeps on rolling, and with each year, the interest you earn is based not just on your initial investment, but also on all the interest you've accumulated over the years. That's the real beauty of compounding. It builds up more and more over time, turning your initial sum into a much bigger amount. Now that we've seen how compounding can magnify your earnings over time, let's explore some strategies to truly harness this power and help you reach your financial dreams. It doesn't matter if you're just starting out or you've been investing for years. These strategies can make a significant impact on your financial future. One of the most effective strategies is to start early. The beauty of compounding is that it's not just about how much you invest, but how long your investment can grow. Starting early gives your money the maximum amount of time to work its magic. Let's think about this with an easy-to-follow example. Imagine if you start setting aside $100 every month for your investments at the age of 25. By the time you're 65, with an average annual return of 7%, you could be looking at a nest egg of over $300,000. And that's the power of starting early and sticking with it. But what if you wait until you're 35 to start saving that same $100 per month? The scenario changes significantly. You'd end up with less than half of that, $300,000, by the time you reach 65. This example highlights a crucial point. Every year you delay, you potentially miss out on a substantial amount of growth. This approach underlines a famous saying attributed to Albert Einstein, who reportedly called compound interest the eighth wonder of the world. By starting early, even with smaller amounts, you allow your investments more time to grow and accrue interest on the interest already earned. Another powerful strategy to maximize your compounding potential is to diversify your portfolio. Just like a gardener plants a variety of seeds to ensure at least some will thrive regardless of the weather, diversifying your investments helps manage risk and increase the potential for returns across different assets. By spreading your investments across different types of assets, like stocks, bonds, and real estate, you not only reduce the risk of one investment's poor performance, significantly hurting your portfolio, but also set the stage for capturing gains from different sectors and markets. And let's not forget about tax-advantaged accounts. Investing in retirement accounts like 401ks or IRAs can be a game changer. These accounts benefit from tax-deferred or even tax-free growth, depending on the account type, which means more of your money stays invested and continues to compound. Think of it as giving your investments a turbo boost, as you don't have to pull out money to pay taxes annually. For example, let's say you decide to invest in both a diversified portfolio and a 401k plan. Not only are you reducing risk by spreading out your investments, but you're also letting your money grow in a tax-advantaged environment, accelerating the compounding effect. Over time, this strategy could significantly increase your investment returns, making a huge difference in your financial situation by the time you retire. Moreover, for those looking to boost their short-term savings, high-yield savings accounts offer an attractive option. While they might not provide the explosive growth potential of stocks or real estate, they do offer a safer place for your money to grow at a faster rate than traditional savings accounts. These accounts might require higher minimum balances or come with some restrictions, but they're worth considering if you're looking to compound your funds more effectively than in a standard savings account. This diversification strategy isn't just theoretical. Many successful investors like Ray Dalio swear by diversification. Dalio, a legendary hedge fund manager, often talks about the importance of a well-diversified investment strategy to reduce risk and improve the likelihood of consistent returns. It's about playing smart and not relying on a single investment to bear all the burden of your financial growth. By the way, if you're enjoying the video so far and want more content like this, comment the word "more" so I know. Moving forward, next strategy is about the power of reinvesting your earnings, just like a farmer who resows some of his harvest to ensure even more produce the next season. Reinvesting dividends and interest payments back into your investments can significantly amplify your financial growth. When you receive dividends or interest from your investments, you stand at a crossroads. Spend it or reinvest it. By choosing to reinvest those earnings, you essentially throw them back into your investment pool. This not only increases your initial investment amount, but also boosts the interest you will earn in the future. It's like building a financial snowball. Each reinvestment makes it bigger and speeds its roll down the wealth hill. For instance, you own shares in a company that pays dividends. Instead of taking those dividends as cash, you choose to reinvest them by buying more shares of the company. Over time, this not only increases the number of shares you own, but also potentially increases the dividends you'll receive in future, assuming the company's dividend payments stay consistent or even grow. Historically, many of the most successful investors have taken this path. Take Warren Buffett again. A significant part of his investment philosophy is to reinvest earnings. This strategy has played a crucial role in compounding his wealth over the decades. Buffett understands that by reinvesting dividends, he's not just maintaining his stake in the business. He's increasing it without spending additional money from his pocket. Reinvesting your earnings doesn't just apply to stocks. It can be a strategy used across various investment vehicles, including bonds and real estate investment trusts, where the profits from these investments can also be reinvested to generate their own returns. Moving forward, another important strategy is keeping your investment fees low. It's akin to ensuring that the tools you use to build your house are affordable, yet effective. Paying too much for them can seriously eat into your budget, just as excessive fees can diminish your investment returns. Fees might seem small when you look at them in isolation, but over time they can have a massive impact on your investment growth. Think of it like a small leak in a water tank. It might not look like much, but over time, a lot of water can be lost. The same goes for your investments. The cumulative effect of fees can significantly reduce what you end up with. For example, imagine you invest $10,000 at a 5% annual interest rate compounded monthly. Over 10 years without any fees, this investment would grow to $16,470. However, if your effective interest rate after fees is only 4%, then after 10 years, you'd end up with $14,802. That's a difference of $1,668 lost to fees, which clearly shows how even a small reduction in your return rate can have a substantial impact over time. To combat this, One effective approach is investing in low-cost index funds or exchange-traded funds, ETFs. These funds are designed to mimic the performance of a specific index and typically have lower expense ratios than actively managed funds. This means you're not paying as much for the management of your investments, which helps keep more of your money working for you. Moreover, being mindful of trading fees and other transaction costs is also key. Every time you buy or sell an investment, you might be paying a fee. While these fees might seem minor at the moment, over many years, they can add up and significantly eat into what you would otherwise earn. This approach of keeping fees low isn't just smart, it's proven. Many successful investors, like John Bogle, the founder of Vanguard and a champion of low-cost investing, have advocated for this method. Bogle famously argued that in investing, you get what you don't pay for, meaning the less you pay in fees, the more you ultimately keep. Next compound strategy for every investor is to stay the course. Investing is indeed a long-term game, reminiscent of a marathon rather than a sprint. It requires patience, perseverance, and a steady hand at the helm, especially during the stormy times of market downturns. Staying the course means resisting the knee-jerk reaction to sell off your investments when the market takes a dip. It's natural to feel a bit panicked when you see numbers dropping, but remember, the market has a history of rebounding. Selling during a low point not only locks in your losses, but also means you might miss out on the gains of a potential rebound. It's like leaving the party just when things start to get better. Consider the legendary investor, Warren Buffett, who is known for his philosophy of buying and holding on to investments through thick and thin. Buffett advises investors to be fearful when others are greedy and greedy when others are fearful. This mindset encourages holding onto investments even when the market looks bleak, with the understanding that values generally increase over the long term. This approach isn't just about avoiding losses. It's about allowing your investments the time they need to truly benefit from the power of compounding. Each year that your money remains invested and potentially grows, it builds on the previous year's growth, which can lead to exponential increases over time. In addition, staying the course is not passive, though. It involves actively maintaining your investment strategy, keeping an eye on your goals, and adjusting only when necessary to align with your long-term objectives, not in response to short-term market fluctuations. By adopting this mindset, you align yourself with some of the most successful investors in history, who have shown that patience and a long-term perspective are critical components of successful investing. This approach will help ensure that your investment strategy remains robust, allowing compounding to work its magic to the fullest extent as you journey toward achieving your dreams. Now let's explore another strategy that can complement your efforts to harness the incredible power of compounding. This is about avoiding early withdrawals from your investments. Just like in gardening, where plucking a fruit too early means it never gets to reach its full sweetness, withdrawing your investment prematurely can significantly diminish its potential growth. When you withdraw your investments early, you're not just losing out on the immediate interest or returns. More critically, you're losing the future interest that could have been earned on those returns. It's a double hit to your compounding potential, like stopping the engine of a train that's just begun to pick up speed. This strategy is vitally important because the true power of compounding becomes most evident over longer periods. Each cycle of reinvestment adds more to the principal, which in turn generates more in returns. By interrupting this cycle prematurely, you drastically reduce the mountain that your financial molehill could have grown into. For instance, think about a young athlete training for the Olympics. If they give up halfway, not only do they lose the progress made so far, but they also lose out on what could have been if they had persisted. In investing, if you withdraw your funds early, perhaps due to a short-term financial goal or a panic reaction to market fluctuations, you similarly cut short what could be substantial long-term gains. Financial experts often cite the example of retirement accounts like 401, COAs, or IRAs to illustrate this point. These accounts are structured to discourage early withdrawals by imposing penalties, precisely because taking out funds early undermines the benefits of long-term compounding. The wisdom of avoiding premature withdrawals is echoed in many financial success stories. Investors who are celebrated today, like Warren Buffett, have often highlighted the importance of letting investments mature fully. Thus, by ensuring that your investments remain intact and continue to grow, you allow each dollar to fully harness the exponential power of compounding. Finally, the next compound strategy for every investor is utilizing laddering techniques. This strategy offers a savvy blend of securing higher interest rates while maintaining some level of liquidity, a crucial balancing act in the world of investing. Laddering involves spreading your investment across several time deposits or bonds with different maturity terms. This not only helps in managing risk by diversifying the maturity periods, but also allows you to take advantage of varying interest rates. It's a bit like planting seeds at different times so that not all your crops are ready at once, providing you with a steady harvest throughout the year. Imagine you have $10,000 to invest. Instead of locking all this money in a single long-term deposit, which might leave you cash-strapped in the short term, you could split this amount into several parts. For example, you could invest $2,000 each in 1 year, 2-year, 3-year, 4-year, and 5-year time deposits. This way, each year one of your deposits matures, giving you access to part of your funds. You can then choose to reinvest these funds into a new 5-year deposit, thereby not only maintaining your investment cycle, but also taking advantage of compounding interest over a new term. This technique not only secures higher returns available from longer-term deposits, but also offers the flexibility of shorter-term access to funds. Each year, as a deposit matures, you have the option to reassess your financial situation and investment strategy. If rates are more favorable, you can reinvest at those higher rates, continuously maximizing your investment's growth potential. The laddering strategy is a favorite among prudent investors who wish to balance the need for short-term liquidity with the desire for long-term growth. It echoes the financial acumen of seasoned investors who understand that flexibility and patience can go hand in hand. For instance, an investor like Benjamin Graham, who emphasized the importance of looking at investment with both a short-term and long-term perspective, would appreciate the strategic depth offered by laddering. By employing a laddering strategy, you effectively create a self-renewing cycle of compounding returns, which can significantly enhance your investment outcomes over time. It's about being smart with how you structure your investments, always keeping an eye on both immediate needs and future growth. So to wrap it all up, think of these compounding strategies as your dance partners in the grand ballroom of investing. Master the steps starting early, diversifying, reinvesting earnings, keeping fees low, staying the course, avoiding early withdrawals, and utilizing laddering techniques, and you'll be gracefully two-stepping past financial pitfalls and waltzing towards a secure and prosperous future. Remember, the purpose of this video is to educate you on various aspects of investing and not to give you any specific investment advice. Investing involves risks and uncertainties, and you should always do your own research and consult with qualified professionals before making any financial decisions. However, past performance does not guarantee future results, and you should always consider the risk of investments before putting your money at stake. If you find this video helpful, I recommend you watch my next video. Don't forget to like, share,